Okay, so in this session, we'll be looking at the methods of relief from double taxation. So we all know that international double taxation may be eliminated either by concession by one state, that is unilaterally or based on their domestic law, or what we call bilaterally based on their tax treaties. Now, so we have two main ways in which we relieve double taxation by way of our domestic laws or by DTAs or what we call tax treaties. Okay, so the unilateral method is what we call the unilateral reliefs. So this method provides for double taxation relief unilaterally by a country to each resident for the taxes paid in the other country, even where a DTA has not been entered into with that country. So Ghana also applies for unilateral relief through the tax credit and exemption through their domestic law. Now, one thing you should know is that in our domestic law, unlike at 592, in our domestic law under section 112, it provides for a domestic relief as well as section 111, subsection 1 and subsection 2. Okay, so we are saying that yes, if you are Ghanaian and you go to another country and you pay taxes, provided that you bring a tax credit certificate from that country, we can't grant you a relief. But if you're able to prove from a receipt from those tax authorities to, let's say you went to Nigeria, you pay some taxes, if you're able to bring the tax receipts taken from the Nigerian tax authorities to Ghana, we can grant you a tax credit or a tax relief, even though we do not have any DTA with the country. Now, the next is a bilateral relief, and under this method, the government of two countries can enter into an agreement to provide relief against double taxation by mutually working out a basis on which the relief is to be granted. So this is mostly effected through the use of double taxation agreements. So Ghana has entered into double taxation agreements with various countries for relief or against the avoidance of double taxation. Okay, so one thing is that in this agreement, or what we call the double taxation agreement, it actually exists to prevent tax avoidance and also to relieve people from double taxation. So bilateral reliefs may be granted under the following methods. The first method is the exemption method. So with the exemption method, a particular income is taxed only in one of the two countries. So in Ghana, few rules cover the exemption method, for instance. Now in our law, section 111 subsection 2 of the Income Tax Act exempts the employment income of a resident from taxation in Ghana if it was exercised in a foreign state. So if you were employed in a foreign state and you meet some particular conditions, then you are what? You are exempted from tax in Ghana, provided you meet those conditions. And the conditions are that you were either employed by a non-resident, or for 183 days or more, you were not in Ghana. You were present in the foreign state. If that is the case, then you are exempted. So with the exemption method, the resident states will exempt any income you bring from the foreign state, not the tax, the income. So the income will be exempted from tax. Because you are taxed on worldwide basis, that income will be exempted completely. So the introduction of the exemption method is to achieve what we call capital import neutrality. So I'll come and explain that later on. So we have what we call the tax credit method. Now with this tax credit method, the income is taxable in both countries under their respective tax laws, read with the double taxation agreement. So the country of residence of the taxpayer, however, allows him credit for the tax charged in the country of source or the foreign country. So the foreign country in which you went to pay the tax, we are going to grant you a credit, okay, like a withholding tax credit for the tax you paid in the foreign country. So after we compute your tax liabilities, we will now deduct that tax from your total taxes you have to pay. It's like you've paid an advance tax already, so we credit you. Okay, like a tax paid in advance. So Ghana follows the credit method in majority of its DTAs with other countries. Also, Ghana has introduced the foreign tax credit rules under Section 112 of the Income Tax Act. So the introduction of the credit method seeks to achieve what we call capital export neutrality. So tax neutrality is the main reason why we introduce some of these things, or we relieve people from double taxation. Now, there are other methods of relief which may also be considered. The next is what we call the deduction method. And with this one, the foreign tax paid are treated as allowable deductions in the resident state against your taxable income. So the deduction method is effected to achieve national neutrality. Now, in Ghana, under Section 112, subsection 3, it allows for the relinquishment of a foreign tax credit by claiming a deduction against your foreign income. This is the only time a deduction is given in respect of a foreign tax. So, for instance, if you have a foreign tax credit and you can't claim it, you can claim a deduction of that tax from your income as an allowable deduction. Okay, now the tax sparing credit is usually used in the past. It's also known as a pioneer relief. So it's a mechanism usually effected in tax treaty provisions whereby one state commits to crediting the taxes that were spared in the other country, meaning it was not paid. And still, they grant you a credit for those taxes that were paid, that were spared in the foreign country. So a tax sparing credit is often given to investors to attract foreign direct investments into a country. So let's say if Ghana is giving you some tax holidays, and I would have paid tax of 500 had it not been the tax holiday, I will still be given a credit for that 500 in my home country, okay, after compiling all the incomes. So that is how a tax sparing. So you are spared of the taxes you would have paid in that foreign country. It is also known as pioneer relief. Please remember this. It's a type of credit. Now, the bilateral methods for relief, we'll cover them in more detail when we are later looking at Article 23A and 23B of the DTs. Okay, so those are more of the exemption and the credit method into detail. Okay, so why do we relieve double taxation? We relieve double taxation to achieve tax neutrality, as I was talking about, and we can do this to achieve capital export neutrality, capital import neutrality, and national neutrality. So what is capital export neutrality? So capital export neutrality requires residents of any given nation to face the same tax burden, no matter where they choose to invest. So wherever you invest, remember that when you bring the income, we will credit you. Once we credit you, it brings you to your normal tax liability, which you would have incurred in the resident state had you not traveled. So that way, investors choose the location of their investment based on where they can get their highest pre-tax return. So it tries to identify conditions under which the investment is allocated efficiently. So imposing the same tax rate regardless of the location ensures the condition is met. So remember that the capital export neutrality is thought to support the foreign tax credit relief of relieving double taxation, or the foreign tax credit of relieving double taxation. Okay, so it follows the credit method because once you are granted credit, it's like the tax. If I am supposed to pay tax of 50 in Ghana and I've already paid 10, then I have to pay 40. So it brings my tax liability to the exact same position. That is why we say that the SEN supports the foreign tax credit method. Now, the next is what we call capital import neutrality. Now, for capital import neutrality, it is more about savings. So it requires all investment in a country to pay the same marginal tax rate, irrespective of whether you are resident or non-resident. Okay, what does this mean? This means that all business activity within a country is subject to the same overall level of taxation. If capital neutrality holds, all savers receive the same after-tax return regardless of their residence, which means the allocation of savings is efficient. SEN supports the exemption method of relieving double taxation. So how do we make sure that you pay the same marginal tax rate, both resident and non-resident? For instance, if you are in Ghana, had you not gone outside the country to bring some income, that income wouldn't be added to your assessable income and taxed. Now, the simple rule is this. I will exempt you from the foreign income so that you are only assessed on the local income. Just like non-residents, they will also be assessed on the same local income that they make in the source state. So we are all centered around the same marginal tax rate, regardless of our residence. So it supports the exemption method. So once there's exemption, capital import neutrality is achieved. Then the next one is to safeguard national revenue, which we call national neutrality. So this claims that from a perspective of the nation or the national perspective, it is optimal to tax foreign source income, but then you have to allow a deduction for the foreign taxes in the same way we allow a deduction for other costs, okay, like capital allowance and the rest. So a tax system will feature this. Are you getting it? To make investors indifferent between the pre-tax return of their domestic investments and the return on their foreign investment after paying their foreign taxes. The key difference between the SEN and the national neutrality is the treatment of paying the foreign taxes. The difference between the SEN and the national neutrality is how we treat the foreign taxes, right? So the SEN treats a foreign government receiving the taxes the same as the home country government receiving the taxes, whilst the national neutrality counts only on the payments to the home country as improving welfare. National neutrality does support the deduction method of relief, yes. So we want to safeguard government revenue, also to improve national welfare. Because of that, we are not granting you a credit and neither are we granting you an exemption, but a deduction so that still we can get the maximum amount of revenue we want. Because a credit reduces the actual taxes while deductions reduce the income to some level. Okay, so it is to safeguard national revenue. So we've looked at the various methods of relief and why we relieve double taxation. Now, in our next session, we are going to be looking at double taxation agreements and what they mean, as they are the major theme or topic of your exam.